Most people lose money in mutual funds not because of markets, but because of one mistake. Choosing a mutual fund without understanding ratios is like buying a car without checking mileage, suspension, or brakes. In this video, we'll understand mutual fund ratios using a simple car analogy. This will help you select smarter funds and avoid common investment mistakes. Expense ratio is the cost of running your mutual fund. Just like fuel and toll charges for a car, this amount is deducted every year from your investment. A fund with 1.8% expense ratio costs around 1800 rupees per lakh annually. A fund with 0.8% costs only 800 rupees. Lower expense ratio means more of your money stays invested and compounds. Sharpe ratio tells us how efficiently a fund converts risk into returns. Think of it as mileage per liter. If two funds give similar returns, the one with higher Sharpe ratio gives better mileage. Higher Sharpe means you are being rewarded more for the risk taken. Alpha shows the skill of the fund manager. If the market gives 10% and your fund gives 12%, alpha is +2. Positive alpha means the manager is outperforming the benchmark. Negative alpha means the manager is underperforming. Choose funds with consistent positive alpha. Beta shows how much a fund moves compared to the market. A beta of 1 means the fund moves exactly like the market. Beta above 1 means more volatility and sharper movements. Beta below 1 means a smoother and more stable ride. Conservative investors usually prefer lower beta funds. Standard deviation measures how much a fund's returns fluctuate. Low standard deviation means stable returns. High standard deviation means big ups and downs, even if average return looks good. A smoother ride is always better for long-term investors. R² shows how closely a fund follows its benchmark. 95% means the fund moves almost like the index. 60% means the fund takes independent decisions. Active funds should not be too close to the index and not completely random either. Sortino ratio focuses only on downside risk. It shows how well a fund performs when markets fall. Higher Sortino means better protection during bad times. This ratio is very important for long-term peace of mind. Information ratio shows how consistently a fund beats its benchmark. Higher information ratio means the fund manager is reliable, not lucky. It's like a GPS that keeps guiding you correctly. Upside capture shows how well a fund performs in rising markets. Downside capture shows how well it protects in falling markets. The ideal fund has high upside capture and low downside capture. Before selecting a mutual fund, always check consistent alpha, high Sharpe and Sortino, reasonable expense ratio, controlled standard deviation, healthy R², stable AUM and at least 5 to 8 years of history. Just like cars, some value speed, some value efficiency, others value safety. Invest according to your goals and risk comfort.